Hi, ladies and gentlemen. We are now in Chapter 4. Are you ready? Do you learn something from the previous 3 chapters? I found it really interesting, and I can't stop reading it. Those are the important mindset we need to start our investment journey. Even though we are in level 0, I believe by keep reading and learning, we will meet the goal one day. Let's begin. The explosive bubbles of the early 2000s. If you can keep your head when all about you are losing theirs. Yours is the earth and everything that's in it. Rudyard Kipling. If financially devastating. As the bubbles of the last decades of the 20th century were, they cannot compare with those of the first decade of the 21st century. When the internet bubble popped in the early 2000s, over $8 trillion of market value evaporated. It was as if a year's output of the economies of Germany, France, England, Italy, Spain, the Netherlands, and Russia had completely disappeared. The entire world economy almost crashed when the U.S. real estate bubble popped and a prolonged world recession followed. Comparing either of these bubbles to the tulip bulb craze is undoubtedly unfair to the flowers. The internet bubble. Most bubbles have been associated with some new technology, as in the tronics and biotech booms, or with some new business opportunity, as when the opening of profitable new trade opportunities spawned the South Sea bubble. The internet was associated with both. It represented a new technology, and it offered new business opportunities that promised to revolutionize the way we obtain information and purchase goods and services. The promise of the internet spawned the largest creation and largest destruction of stock market wealth of all time. Robert Shiller, in his book Irrational Exuberance, describes bubbles in terms of positive feedback loops. A bubble starts when any group of stocks, in this case those associated with the excitement of the internet, begin to rise. The updraft encourages more people to buy the stocks, which causes more TV and print coverage, which causes even more people to buy, which creates big profits for early internet stockholders. The successful investors tell you at cocktail parties how easy it is to get rich, which causes the stocks to rise further, which pulls in larger and larger groups of investors. But the whole mechanism is a kind of Ponzi scheme where more and more credulous investors must be found to buy the stock from the earlier investors. Eventually, one runs out of greater fools. Even highly respected Wall Street firms joined in the hot air float. The venerable investment firm Goldman Sachs argued in mid-2000 that the cash burned by the dot-com companies was primarily an investor sentiment issue and not a long-term risk for the sector or space, as it was often called. A few months later, hundreds of internet companies were bankrupt, proving that the Goldman report was inadvertently correct. The cash burn rate was not a long-term risk, it was a short-term risk. Until that moment, anyone scoffing at the potential for the new economy was a hopeless Luddite. As the chart on page 81 indicates, the NASDAQ index, an index essentially representing high-tech new economy companies, more than tripled from late 1998 to March 2000. The price-earnings multiples of the stocks in the index that had earnings soared to over 100. A broad-scale high-tech bubble. At the bubble's height, scoffers were hard to find. Surveys of investors in early 2000 revealed that expectations of future stock returns ranged from 15% per year to 25% or higher. For companies such as Cisco and JDS Uniphase, widely known as producing the backbone of the internet, 15% returns per year were considered a slam dunk. But Cisco was selling at a triple-digit multiple of earnings and had a market capitalization of almost $600 billion. If Cisco grew its earnings at 15% per year, it would still be selling at a well-above-average multiple 10 years later. And if Cisco returned 15% per year for the next 25 years and the national economy continued to grow at 5% over the same period, Cisco would have been bigger than the entire economy. Obviously, there was a complete disconnect between stock market valuations and any reasonable expectations of future growth. And even blue-chip Cisco lost over 90% of its market value when the bubble burst, and the forecasted growth never happened. As for JDS Uniphase, the following chart plots its prices against the NASDAQ index from mid-1997 through mid-2002. By comparison, the bubble in the overall index is hardly noticeable. In the name game during the Tronics boom, all manner of companies added the suffix Tronics to increase their attractiveness. The same happened during the Internet mania. Dozens of companies, even those that had little or nothing to do with the net, changed their names to include web-oriented designations such as .com, .net, or Internet. 3 researchers from Purdue University, M. Cooper, D. Dimitrov, and P. R. Rao, studied 63 companies that changed their names in 1998 and 1999 to include some web orientation. Measuring the price change of the companies from 5 days prior to a name change, when word of the change began to leak out, to 5 days after the change was announced, they confirmed a remarkable effect. Companies that changed their names enjoyed an increase in price during that 10-day period that was 125% greater than that of their peers. This price increase occurred even when the company's core business had nothing whatsoever to do with the net. In the market decline that followed, shares in these companies became worthless. As the following table shows, investors suffered punishing losses even in the leading Internet companies. Palm Pilot, the maker of personal digital assistants, PDAs, is an example of the insanity that went well beyond irrational exuberance. Palm was owned by a company called 3Com, which decided to spin it off to its shareholders. Since PDAs were touted as a sine qua non of the digital revolution, it was assumed that Palm Pilot would be a particularly exciting stock. Little did 3Com know how strongly the market would react. In early 2000, 3Com sold 5% of its shares in Palm in an initial public offering and announced its intention to spin off all the remaining shares to the 3Com shareholders. Palm took off so fast that its market capitalization became twice as large as that of 3Com. It turned out that the market value of the 95% of Palm owned by 3Com was almost $25 billion greater than the total market capitalization of 3Com itself. It was as if all of 3Com's other assets had been worth a negative $25 billion. If you wanted to buy Palm Pilot, you could have bought 3Com and owned the rest of 3Com's business for minus $61 per share. In its mindless search for riches, the market created anomalies that were even stranger than the fraudulent accounting practices that were soon to be revealed. Yet another new issue craze. In the first quarter of 2000, 916 venture capital firms invested $15.7 billion in 1,009 startup internet companies. Many were playing catch-up. An astonishing 159 initial public offerings, IPOs, had been successfully completed in the preceding quarter. It was as if the stock market was on steroids. As happened during the South Sea bubble, many companies that received financing were absurd. Almost all turned out to be .com catastrophes. Consider the following examples of internet startups. DigiSense offered a peripheral you could plug into your computer that would make websites and computer games smell. The company ran through millions from venture capitalists trying to develop such a product. Flues offered an alternative currency Flues that could be emailed to friends and family. It was not quite money because there were only a few places you could use it, but it sure made a unique gift. In order to jumpstart the company, Flues.com turned to an old business school maxim that any idiot can sell a $1 bill for 80 cents. Flues.com launched a special offer to American Express Platinum card holders, allowing them to buy $1,000 of Flues currency for just $800. Shortly before declaring bankruptcy, Flues itself was flused when Filipino and Russian gangs bought $300,000 of its currency using stolen credit card numbers. Consider Pets.com, a real dog if there ever was one. The company had a sock puppet mascot that starred in its TV commercials and even made an appearance at a Macy's Thanksgiving Day parade. Unfortunately, the popularity of its mascot did not compensate for the fact that it's hard to make a profit individually shipping low-margin 25-pound bags of kibble. The names alone of many of the internet ventures stretch credulity. Bunions.com, Crayfish, Zap.com, Gadzooks, Fogdog, Fatbrain, Jungle.com, Scoot.com, MyLackey.com, and Moreover.com. And then there was Esboard.com, which produced internet pages called toilet paper to help you get the poop on the online community. These were not business models. They were models for business failure. Philip J. Kaplan proved to be a brilliant chronicler of the stupidity of the new .com financings. Deciding to kill some time during a Memorial Day weekend just after the bubble deflated, he set up a website, fuckedcompany.com, that offered the latest gossip about sinking .com companies, as well as a betting pool on when the companies would go under. The website could be accessed by filling in the expurgated characters censored above. The site attracted 4 million viewers. Kaplan then published a book named after the site where he ridiculed 100 of the most ludicrous of the .com business ideas. Here is how Kaplan described the flameout of swapit.com. So let me get this straight. 1. I send them a CD. 2. They give me useless swap-it bucks. 3. They go out of business. 4. I get nothing. Great. Sign me up. Swapit.com was a fiercely stupid idea. The premise was that people could trade used CDs and video games with one another by physically mailing their crap to swapit.com. Users would then be issued swap-it bucks that they could use to buy other people's crap that had also been sent to the company. eBay's entire success is based on the fact that they have no inventory. By dealing with all the inventory and fulfillment, Swapit is like all of the crap with none of the benefit. TheGlobe.com, my most vivid memory of the IPO boom, dates back to an early morning in November 1998, when I was being interviewed on a TV show. While waiting in my suit and tie in the green room, I thought how out of place it was to be sitting next to 2 young men dressed in jeans who, while in their early 20s, looked like teenagers. Little did I realize that they were the first superstars of the internet boom and the featured attractions on the show. Stephen Paterno and Todd Kriselman had formed TheGlobe.com in Todd's dorm room at Cornell. The company was an online message board system that hoped to generate large revenues from selling banner advertising. In earlier times, one needed actual revenues and profits to come to market with an IPO. TheGlobe.com had neither. Nevertheless, its bankers, Credit Suisse, First Boston, brought it to market at a price of $9 per share. The price immediately soared to $97, at that time the largest first-day gain in history, giving the company a market value of nearly $1 billion and making the 2 founders multimillionaires. That day, we learned that investors would throw money at businesses that only 5 years before would not have passed normal due diligence hurdles. The initial public offering of TheGlobe.com was the catalyst that launched the pathological phase of the internet bubble. The relationship between profits and share price had been severed, and a wave of money-losing ventures rushed to the market with IPOs. As for Paterno, a CNN segment in 1999 caught him at a trendy New York nightclub dancing on a table in shiny plastic black pants with his trophy model girlfriend. On camera, Paterno was heard to say, "Got the girl, got the money. Now I'm ready to live a disgusting, frivolous life." Paterno and Kriselman became known as the global poster boys of internet excess. TheGlobe.com closed its website in 2001. And though Paterno may no longer be living a disgusting life, in 2010, he was serving as executive producer of the independent film Down and Dirty Pictures. While the party was still going strong in early 2000, John Doerr, a leading venture capitalist with the preeminent firm of Kleiner Perkins, called the rise in internet-related stocks the greatest legal creation of wealth in the history of the planet. In 2002, he neglected to write that it was also the greatest legal destruction of wealth on the planet. Security analysts peak up. Wall Street's high-profile securities analysts provided much of the hot air floating the internet bubble. Mary Meeker of Morgan Stanley, Henry Blodgett of Merrill Lynch, and Jack Grubman of Salomon Smith Barney became household names and were accorded superstar status. Meeker was dubbed by barons the Queen of the Net. Blodgett was known as King Henry, while Grubman acquired the sobriquet Telecom Guru. Like sports heroes, each of them was earning a multi-million-dollar salary. Their incomes, however, were based not on the quality of their analysis, but rather on their ability to steer lucrative investment banking business to their firms by implicitly promising that their ongoing favorable research coverage would provide continuing support for the initial public offerings in the aftermarket. Traditionally, a Chinese wall was supposed to separate the research function of Wall Street firms, which is supposed to work for the benefit of investors, from the very profitable investment banking function, which works for the benefit of corporate clients. But during the bubble, that wall became more like Swiss cheese. Analysts were the very public cheerleaders for the boom. Blodgett flatly stated that traditional valuation metrics were not relevant in the Big Bang stage of an industry. Meeker suggested in a flattering New Yorker profile in 1999 that this is a time to be rationally reckless. Their public comments on individual stocks made prices soar. And why not? Stock selections were described in terms of powerful baseball hits. A stock that would be expected to quadruple was a 4-bagger. More exciting stocks might be 10-baggers. Securities analysts always find reasons to be bullish. They seldom utter the 4-letter sell word because they do not want to endanger current or future investment banking relationships or to offend corporate chief financial officers. Traditionally, 10 stocks were rated buys for each one rated sell, but during the bubble, the ratio was almost 100-to-1. And as stocks soared, Americans became convinced that investing was easy. They watched CNBC's interviews with their favorite investment gurus, devouring the fluff the analysts were peddling. When the bubble burst, the celebrity analysts faced death threats and lawsuits, and their firms faced investigations and fines by the SEC and the New York State Attorney General Eliot Spitzer. Blodgett was renamed the Clown Prince of the Internet bubble by the New York Post. Grubman was ridiculed before a congressional committee for his continuous touting of WorldCom stock and investigated for changing his stock ratings to help obtain investment banking business. Both Blodgett and Grubman left their firms. Fortune magazine summed it all up with a picture of Mary Meeker on the cover and the caption, "Can we ever trust Wall Street again? New valuation metrics." In order to justify ever higher prices for Internet-related companies, security analysts began to use a variety of new metrics that could be used to value the stocks. After all, the new economy stocks were a breed apart. They should certainly not be held to the fuddy-duddy old-fashioned standards, such as price-earnings multiples, that had been used to value traditional old economy companies. Somehow, in the brave new Internet world, sales, revenues, and profits were irrelevant. In order to value Internet companies, analysts looked instead at eyeballs, the number of people viewing a web page or visiting a website. Particularly important were numbers of engaged shoppers, those who spent at least 3 minutes on a website. Mary Meeker gushed enthusiastically about Drugstore.com because 48% of the eyeballs viewing the site were engaged shoppers. No one cared whether the engaged shopper ever forked over any greenbacks. Sales were so old-fashioned. Drugstore.com hit 60 cents having $50 during the height of the bubble of 2000. A year later, when eyeballs started looking at profits, it was a penny stock. Mindshare was another popular non-financial metric that convinced me that investors had lost their collective minds. For example, the online home seller Homestore.com was highly recommended in October 2000 by Morgan Stanley. because 72% of all the time spent by Internet users on real estate websites was spent on properties listed by Homestore.com. But mindshare did not lead Internet users to make up their minds to buy the properties listed, and did not prevent Homestore.com from falling 99% from its high during 2001. Special metrics were established for telecom companies. Security analysts clambered into tunnels to count the miles of fiber optic cable in the ground, rather than examining the tiny fraction that was actually lit up with traffic. Each telecom company borrowed money with abandon, and enough fiber was laid to circle the earth 2,500 times. As a sign of the times, the telecom and internet service provider PSI Net, now bankrupt, put its name on the Baltimore Ravens football field. As the prices of telecom stocks continued to skyrocket well past any normal valuation standards, security analysts did what they often do. They just lowered their standards. The ease with which telecoms could raise money from Wall Street led to massive oversupply, too much long-distance fiber optic cable, too many computers, and too many telecom companies. In 2002, Mighty WorldCom declared bankruptcy, and the big equipment companies such as Lucent and Nortel, which had engaged in risky vendor financing deals, suffered staggering losses. Most of the $1 trillion thrown into telecom investments during the bubble vaporized. One of the jokes making the rounds of the internet in 2001 went as follows. Tip of the week. If you bought $1,000 worth of Nortel stock 1 year ago, it would now be worth $49. If you bought $1,000 worth of Budweiser, the beer, not the stock, 1 year ago, drank all the beer and traded in the cans for the nickel deposit, you would have $79. My advice to you, start drinking heavily. By the fall of 2002, the $1,000 put into Nortel stock was worth only $3, the rights of the media. The bubble was aided and abetted by the media, which turned us into a nation of traders. Like the stock market, journalism is subject to the laws of supply and demand. Since investors wanted more information about internet investing opportunities, the supply of magazines increased to fill the need. And since readers were not interested in downbeat skeptical analyses, they flocked to those publications that promised an easy road to riches. Investment magazines featured stories such as Internet Stocks Likely to Double in the Months Ahead. As Jane Bryant Quinn remarked, it was investment pornography. Soft core rather than hardcore, but pornography all the same. A number of business and technology magazines devoted to the internet sprang up to satisfy the insatiable public desire for more information. Wired described itself as the vanguard of the digital revolution. The industry standard's IPO tracker was the most widely followed index in Silicon Valley. Business 2.0 prided itself as the oracle of the new economy. The proliferation of publications was a classic sign of a speculative bubble. The historian Edward Chancellor pointed out that during the 1840s, 14 weeklies and 2 dailies were introduced to cover the new railroad industry. During the financial crisis of 1847, many of the rail publications perished. When the industry standard failed in 2001, the New York Times editorialized, "It may well go down as the day the buzz died." The internet itself became the media. No longer did the individual investor have to consult the Wall Street Journal or call a broker to get a stock's price quote. All the information needed was available online in real time. The web provided stock summaries, analyst ratings, past stock charts, forecasts of next quarter's earnings and long-term growth, and instant access to any news items about most any stock. The internet had democratized the investment process, and it played an important enabling role in perpetuating the bubble. Online brokers were also a critical factor in fueling the internet boom. Trading was cheap, at least in terms of the small dollar amount of commissions charged. Actually, the costs of trading were larger than most online brokers advertised, since much of the cost is buried in the spread between a dealer's bid price, the price at which a customer could sell, and the asked price, the price at which a customer could buy. The discount brokerage firms advertised heavily and made it seem that it was easy to beat the market. In one commercial, the customer boasted that she did not simply want to beat the market, but to throttle its scrawny little body to the ground and make it beg for mercy. In another popular TV commercial, Stuart, the cyber geek from the mailroom, was encouraging his old-fashioned boss to make his first online stock purchase with the exhortation, "Let's light this candle." When the boss protested that he knew nothing about the stock, Stuart said, "Let's research it." After one click on the keyboard, the boss, thinking himself much wiser, bought his first 100 shares. Cable networks such as CNBC and Bloomberg became cultural phenomena. Across the world, health clubs, airports, bars, and restaurants were permanently tuned in to CNBC. The stock market was treated like a sports event with a pregame show, what to expect before the market opened, a play-by-play during trading hours, and a post-game show to review the day's action and to prepare investors for the next. CNBC implied that listening would put you ahead of the curve. Most guests were bullish. CNBC's former commentator Maria, the money honey, Bartiromo particularly favored scheduling interviews with analysts who could say with confidence that some $50 dot-com stock would soon go to $500. There was no need to remind a CNBC anchor that, just as the family dog that bites the baby is likely to have a short tenure, sourpuss skeptics did not encourage high ratings. The market was a hotter story than sex. Even Howard Stern would interrupt more usual discussions about porn queens and body parts to muse about the stock market and then to tout some particular internet stocks. Turnover reached an all-time high. The average holding period for a typical stock was no longer years or months, but days and even hours. Redemption ratios of mutual funds, the percentage of the fund's assets redeemed, soared, and the volatility of individual stock prices exploded. The 10 most volatile stocks in each trading day used to rise or fall by 5%. By early 2000, the biggest price changes were 50% or more. And there were 10 million internet day traders, many of whom had quit their jobs to go down the easy path to riches. For them, the long term meant later in the morning. It was lunacy. People who would spend hours researching the pros and cons of buying a $50 kitchen appliance would risk tens of thousands on a chat room tip. Terrence O'Dean, an appliance would risk tens of thousands on a chat room tip. Terrence O'Dean, a finance professor who studies investor behavior, found with his colleagues that most internet traders actually lost money even during the bubble, systematically buying and selling the wrong stocks, and that they performed worse the more they traded. The average survival time for day traders was about 6 months. Fraud slithers in and strangles the market. Speculative manias, such as the internet bubble, bring out the worst aspects of our system. Let there be no mistake. It was the extraordinary new economy mania that encouraged a string of business scandals that shook the capitalist system to its roots. Many businesses were managed not for the creation of long-run value, but for the immediate gratification of speculators. When Wall Street's conflicted sell-side analysts looked for high short-term forecasted earnings to justify outlandishly high stock prices, many corporate managers willingly obliged, and if aggressive earnings targets proved hard to meet, creative accounting could be used so that not only the published street estimates, but even the whisper numbers could be surpassed. One spectacular example was the rise and subsequent bankruptcy of Enron, at one time the 7th largest corporation in America. The collapse of Enron, where over $65 billion of market value was wiped out, can be understood only in the context of the enormous bubble in the new economy, part of the stock market. Enron was seen as the perfect new economy stock that could dominate the market not just for energy, but also for broadband communications, widespread electronic trading, and commerce. Enron was a clear favorite of Wall Street analysts. Even after it began to unravel during the fall of 2001, 16 out of 17 security analysts covering Enron had buy or strong buy ratings on the stock. Old utility and energy companies were likened by Fortune magazine to a bunch of old fogies and their wives shuffling around to the sounds of Guy Lombardo. Enron was likened to a young Elvis Presley crashing through the skylight in his skin-tight gold lame suit. The writer left out the part where Elvis ate himself to death. Enron set the standard for thinking outside the box, the quintessential killer app, paradigm-shifting company. Unfortunately, it also set new standards for obfuscation and deception. One of the scams perpetrated by Enron management was the establishment of a myriad of complex partnerships that obfuscated the true financial position of the firm and led to an overstatement of Enron's earnings. Here is how one of the simpler ones worked. Enron formed a joint venture with Blockbuster to rent out movies online. The deal failed several months later, but after the venture was formed, Enron secretly set up a partnership with a Canadian bank that essentially lent Enron $115 million in exchange for future profits from the Blockbuster venture. Of course, the Blockbuster deal never made a nickel, but Enron counted the $115 million loan as a profit. Wall Street analysts applauded and called Ken Lay, Enron's chairman, the mastermind of the year. Other partnerships with names like Charuko, named for Chewbacca, the Star Wars Wookiee, Raptor, and Jedi, had similar effects, since the force was clearly with Enron. And the force was generous. Before the law caught up with him, Andrew Fastow, Enron's chief financial officer, made $30 million in fees for running independent partnerships. The partnerships were kept off Enron's financial statements, which had the effect of inflating earnings and obscuring losses and indebtedness. The accounting firm of Arthur Andersen certified the books as fairly stating Enron's financial condition, and Wall Street was delighted to collect lucrative fees from the creative partnerships that were established. Deception appeared to be a way of life at Enron. The Wall Street Journal reported that Ken Lay and Jeff Skilling, Enron's top executives, were personally involved in establishing a fake trading room to impress Wall Street security analysts in an episode employees referred to as the Sting. The best equipment was purchased, employees were given parts to play arranging fictitious deals, and even the phone lines were painted black to make the operation look particularly slick. The whole thing was an elaborate charade. In 2006, Lay and Skilling were convicted of conspiracy and fraud. A broken man, Ken Lay died later that year. One employee who lost his job and his retirement savings when Enron collapsed into bankruptcy took to the web where he sold T-shirts with the message, "I got laid by Enron." But Enron was only one of a number of accounting frauds that were perpetrated on unsuspecting investors. Various telecom companies overstated revenues through swaps of fiber optic capacity at inflated prices. Tyco created cookie jar reserves and accelerated pre-merger outlays to spring-load earnings from acquisitions. WorldCom admitted that it had overstated profits and cash flow by $7 billion by classifying ordinary expenses, which should have been charged against earnings, as capital investments, which were not deducted from the bottom line. In far too many cases, corporate chief executive officers, CEOs, acted more like chief embezzlement officers, and some chief financial officers, CFOs, could more appropriately be called corporate fraud officers. While analysts were praising stocks like Enron and WorldCom to the skies, some corporate officers were transforming the meaning of EBITDA from earnings before interest, taxes, depreciation, and amortization to earnings before I tricked the dumb auditor. Should we have known the dangers? Fraud aside, we should have known better. We should have known that investments in transforming technologies have often proved unrewarding for investors. In the 1850s, the railroad was widely expected to greatly increase the efficiency of communications and commerce. It certainly did so, but it did not justify the prices of railroad stocks, which rose to enormous speculative heights before collapsing in August 1857. A century later, Airlines and television manufacturers transformed our country, but most of the early investors lost their shirts. The key to investing is not how much an industry will affect society or even how much it will grow, but rather its ability to make and sustain profits. And history tells us that eventually all excessively exuberant markets succumb to the laws of gravity. The consistent losers in the market, from my personal experience, are those who are unable to resist being swept up in some kind of tulip bulb craze. It is not hard, really, to make money in the market. As we shall see later, an investor who simply buys and holds a broad-based portfolio of stocks can make reasonably generous long-run returns. What is hard to avoid is the alluring temptation to throw your money away on short, get-rich-quick speculative binges. There were many villains in this morality tale. The fee-obsessed underwriters who should have known better than to peddle all of the crap they brought to market. The research analysts who were the cheerleaders for the banking departments and who were eager to recommend net stocks that could be pushed by commission-hungry brokers. Corporate executives using creative accounting to inflate their profits. But it was the infectious greed of individual investors and their susceptibility to get-rich-quick schemes that allowed the bubble to expand. And yet the melody lingers on. I have a friend who built a modest investment stake into a small fortune with a diversified portfolio of bonds, real estate funds, and stock funds that owned a broad selection of blue-chip companies. But he was restless. At cocktail parties, he kept running into people boasting about this internet stock that tripled or that telecom chip maker that doubled. He wanted some of the action. Along came a stock called Boo.com, an internet retailer that planned to sell with no discounts urban chic clothing that was so cool it wasn't even cool yet. In other words, Boo.com was going to sell at full-price clothes that people were not yet wearing. But my friend had seen the cover of Time with the headline, "Kiss Your Mall Goodbye. Online shopping is faster, cheaper, and better." The prestigious firm of J.P. Morgan had invested millions in the company, and Fortune called it one of the cool companies of 1999. My friend was hooked. This Boo.com story will have all the tape watchers drooling with excitement and conjuring up visions of castles in the air. Any delay in buying would be self-defeating. And so my friend had to rush in before greater fools would tread. The company blew through $135 million in 2 years before going bankrupt. The co-founder, answering charges that her firm spent too extravagantly, explained, "I only flew Concorde 3 times, and they were all special offers." Of course, my friend had bought in just at the height of the bubble, and he lost his entire investment when the firm declared bankruptcy. The ability to avoid such horrendous mistakes is probably the most important factor in preserving one's capital and allowing it to grow. The lesson is so obvious, and yet so easy to ignore. The U.S. housing bubble and crash of the early 2000s. Although the internet bubble may have been the biggest stock market bubble in the United States, the bubble in single-family home prices that inflated during the early years of the new millennium was undoubtedly the biggest U.S. real estate bubble of all time. Moreover, the boom and later collapse in house prices had far greater significance for the average American than any gyrations in the stock market. The single-family home represents the largest asset in the portfolios of most ordinary investors, so falling home prices have an immediate impact on family wealth and sense of well-being. The deflation of the housing bubble almost brought down the U.S. as well as the international financial system and ushered in a sharp and painful worldwide recession. In order to understand how this bubble was financed and why it created such far-reaching collateral damage, we need to understand the fundamental changes in the banking and financial systems. A story I like to tell concerns a middle-aged woman who has a serious heart attack. As she is lying in the emergency room, she has a near-death experience in which she comes face-to-face with God. "Is this it?" she asks. "Am I about to die?" God assures her that she will survive and that she has 30 more years to live. Sure enough, she does survive, gets stents put in to open up her clogged arteries, and feels better than ever. She then says to herself, "If I have 30 more arteries," and feels better than ever. She then says to herself, "If I have 30 more years to live, I might as well make the most of it." And since she's already in the hospital, she decides to undergo what might charitably be called comprehensive cosmetic surgery. Now she looks and feels great. With a jaunty step, she bounds out of the hospital, only to be hit by a speeding ambulance and instantly killed. She goes to the pearly gates and again meets God. "What happened?" she asks. "I thought I had 30 more years to live." "I'm terribly sorry, madam," God responds. "I didn't recognize you." The new system of banking. If a financier had awakened from a 30-year nap during the early 2000s, the financial system would have appeared unrecognizable as well. Under the old system, which might be called the originate and hold system, banks would make mortgage loans, as well as loans to businesses and consumers, and hold those loans as assets until they were repaid. In such an environment, bankers were very careful about the loans they made. After all, if a mortgage loan went into default, someone would come back to the loan officer who made the loan and question the original credit judgment. In this environment, both substantial down payments and documentation were required to verify the creditworthiness of the borrower. This system fundamentally changed in the early 2000s to what might be called the originate and distribute model of banking. Mortgage loans were still made by banks, as well as by big specialized mortgage companies. But the loans were held by the originating institution for only a few days until they could be sold to an investment banker. The investment banker would then assemble packages of these mortgages and issue mortgage-backed securities derivative bonds securitized by the underlying mortgages. These collateralized securities relied on the payments of interest and principal from the underlying mortgages to service the interest payment on the new mortgage-backed bonds that were issued. To make matters even more complicated, there was not just one bond issued against a package of mortgages. The mortgage-backed securities were sliced into different tranches, each tranche with different claim priority against payments from the underlying mortgages and each with a different bond rating. It was called financial engineering. Even if the underlying mortgage loans were of low quality, the bond rating agencies were happy to bestow an 8AA rating on the bond tranches with the first claims on the payments of interest and principal from the underlying mortgages. The system should more accurately be called financial alchemy, and the alchemy was employed not only with mortgages, but with all sorts of underlying instruments, such as credit card loans and automobile loans. These derivative securities were in turn sold all over the world. It gets even murkier. Second-order derivatives were sold on the derivative mortgage-backed bonds. Credit default swaps were issued as insurance policies on the mortgage-backed bonds. Briefly, the swap market allowed two parties called counterparties to bet for or against the performance of the mortgage bonds or the bonds of any other issuer. For example, suppose I hold bonds issued by General Electric and I begin to worry about GE's creditworthiness. I could buy and hold an insurance policy from a company like AIG, the biggest issuer of credit default swaps, that would pay me if GE defaulted. The problems with this market lay in the fact that the issuers of the insurance, such as AIG, had inadequate reserves to pay the claims if trouble occurred. And anyone from any country could buy the insurance, even without owning the underlying bonds. Eventually, the credit default swaps trading in the market grew to as much as 10 times the value of the underlying bonds, pushed by demand from institutions around the world. This change, where the derivative markets grew to a large multiple of the underlying markets, was a crucial feature of the new finance system. It made the world's financial system very much riskier and much more interconnected. Looser lending standards. To round out this dangerous picture, the financiers created structured investment vehicles, or SIVs, that kept derivative securities off their books in places where the banking regulators couldn't see them. The mortgage-backed security SIV would borrow the money needed to buy the derivatives, and all that showed up on the investment bank's balance sheet was a small investment in the equity of the SIV. In the past, banking regulators might have flagged the vast leverage and the risk it carried, but that was overlooked in the new finance system. This new system led to looser and looser lending standards by bankers and mortgage companies. If the only risk a lender took was the risk that a mortgage loan would go bad in the few days before it could be sold to the investment banker, the lender did not need to be as careful about the credit worthiness of the borrower. And so the standards for making mortgage loans deteriorated sharply. When I took out my first home mortgage, the lender insisted on at least a 30% down payment. But in the new system, loans were made with no equity down in the hopes that housing prices would rise forever. Moreover, so-called ninja loans were common. Those were loans to people with no income, no job, and no assets. Increasingly, lenders did not even bother to ask for documentation about ability to pay. Those were called no-doc loans. Money for housing was freely available, and housing prices rose rapidly. The government itself played an active role in inflating the housing bubble. Under pressure by Congress to make mortgage loans easily available, the Federal Housing Administration was directed to guarantee the mortgages of low-income borrowers. Indeed, almost two-thirds of the bad mortgages on the financial system as of the start of 2010 were bought by government agencies or required by government regulations. The government not only failed as a regulator of financial institutions, but also contributed to the bubble by its own policies. No accurate history of the housing bubble can fail to recognize that it was not simply predatory lenders, but the government itself that caused many mortgage loans to be made to people who did not have the wherewithal to service them. The housing bubble. The combination of government policies and changed lending practices led to an enormous increase in the demand for houses. Fueled by easy credit, house prices began to rise rapidly. The initial rise in prices encouraged even more buyers. Buying houses or apartments appeared to be risk-free, as house prices appeared consistently to go up. And some buyers made their purchases with the objective not of finding a place to live, but rather of quickly selling, flipping the house to some future buyer at a higher price. The pattern was eerily similar to that of the bubbles described earlier. The graph on page 102 illustrates the dimensions of the bubble. The data come from the Case-Shiller inflation-adjusted home price indexes. The adjustment works by considering that if house prices increased by 5%, when prices in general increased by 5%, no inflation-adjusted housing price increase occurred. If house prices went up by 10%, however, then the inflation-adjusted price would be recorded as a 5% increase. The graph shows that for the 100-year period from the late 1800s to the late 1900s, inflation-adjusted house prices were stable. House prices went up, but only as much as the general price level. Prices did dip during the Great Depression of the 1930s, but they ended the century at the same level at which they started. In the early 2000s, the house price index doubled. This index is a composite index of prices in 20 cities. In some cities, prices increased far more than the national average. What we know about all bubbles is that eventually they pop. The next graph depicts the damage. The decline was broad-based and devastating. Many home buyers found that the amount of their mortgage far exceeded the value of their home. Increasingly, they defaulted and returned the house keys to the lender. In an instance of macabre financial humor, bankers referred to this practice as jingle mail. On average, home prices declined by 1/3, not only wiping out the real estate equity of millions of Americans, but bankrupting many of the largest financial institutions. Data Standard & Poor's. Seasonally adjusted. The effects on the economy were devastating. As home equity collapsed, consumers pulled in their horns and went on a spending strike. And consumers who previously might have taken out a second mortgage on a home equity loan on their house were no longer able to finance their consumption in that manner. The drop in house prices destroyed the value of the mortgage-backed securities as well as the leveraged financial institutions that had eaten their own cooking and that held vast amounts of these toxic assets with borrowed money. Spectacular bankruptcies ensued, and some of our largest financial institutions had to be rescued by the government. Lending institutions turned full circle, and credit was shut off both to small businesses and to consumers. The recession that followed in the United States was painful and prolonged, exceeded in its intensity only by the Great Depression of the 1930s. Bubbles and economic activity. Our survey of historical bubbles makes clear that the bursting of bubbles has invariably been followed by severe disruptions in real economic activity. The fallout from asset price bubbles has not been confined to speculators. Bubbles are particularly dangerous when they are associated with a credit boom and widespread increases in leverage both for consumers and for financial institutions. The experience of the United States during the early 2000s provides a dramatic illustration. Increased demand for housing raised home prices, which in turn encouraged further mortgage lending, which led to further price increases in a continuing positive feedback loop. The cycle of increased leverage involved loosening credit standards, and even further increase in leverage. At the end of the process, individuals and institutions alike became dangerously vulnerable. When the bubble bursts, the feedback loop goes into reverse. Prices decline, and individuals find not only that their wealth has declined, but that in many cases their mortgage indebtedness exceeds the value of their houses. Loans then go sour and consumers reduce their spending. Overly leveraged financial institutions begin a deleveraging process. The attendant tightening of credit weakens economic activity further, and the outcome of the negative feedback loop is a severe recession. Credit boom bubbles are the ones that pose the greatest danger to real economic activity. Does this mean that markets are inefficient? This chapter's review of the internet and housing bubbles seems inconsistent with the view that our stock and real estate markets are rational and efficient. The lesson, however, is not that markets occasionally can be irrational and that we should therefore abandon the firm foundation theory of the pricing of financial assets. Rather, the clear conclusion is that in every case, the market did correct itself. The market eventually corrects any irrationality, albeit in its own slow, inexorable fashion. Anomalies can crop up, markets can get irrationally optimistic, and often they attract unwary investors. But eventually, true value is recognized by the market, and this is the main lesson investors must heed. I am also persuaded by the wisdom of Benjamin Graham, author of Security Analysis, who wrote that in the final analysis, the stock market is not a voting mechanism, but a weighing mechanism. Valuation metrics have not changed. Eventually, every stock can only be worth the present value of the cash flow it is able to earn for the benefit of investors. In the final analysis, true value will win out. The important investment question is how you can estimate true value. More about this in Chapter 5, where we will take a closer look at how professionals attempt to determine what a stock is truly worth. Markets can be highly efficient even if they make errors. Some are doozies, as when internet stocks in the early 2000s appeared to discount not only the future but the hereafter. How could it be otherwise? Stock valuations depend upon estimations of the earning power of companies many years into the future. Such estimations of the earning power of companies many years into the future. Such forecasts are invariably incorrect. Moreover, investment risk is never clearly perceived, so the appropriate rate at which the future should be discounted is never certain. Thus, market prices must always be wrong to some extent. But at any particular time, it is not obvious to anyone whether they are too high or too low. The evidence I will present next shows that professional investors are not able to adjust their portfolios so that they hold only undervalued stocks and avoid overvalued ones. The fact that the best and the brightest on Wall Street cannot consistently distinguish correct valuations from incorrect ones shows how hard it is to beat the market. There is no evidence that anyone can generate excess returns by making consistently correct bets against the collective wisdom of the market. Markets are not always or even usually correct, but no one person or institution consistently knows more than the market. Nor does the unprecedented bubble and bust in house prices during the first decade of the 2000s drive a stake through the heart of the efficient market hypothesis. If individuals are given an opportunity to buy houses with no money down, it can be the height of rationality to be willing to pay an inflated price. If the house continues to escalate in value, the buyer will profit. If the bubble bursts and the house price declines, the buyer walks away and leaves the lender, and perhaps ultimately the government, with the loss. Yes, the incentives were perverse, and in retrospect, regulation was lax, and some government policies were ill-considered. But in no sense was this sorry episode and the deep recession that followed caused by a blind faith in the efficient market hypothesis. That's it for the Chapter 4. Take a break for yourself and we will start the next chapter. Cheer!